Hello and welcome to Views from the Top. I'm Sarah Allen and today I'm joined by Steve Kane. Steve is a portfolio manager for diversified alternatives with Janus Henderson Investors. We're going to have a look at the macro outlook and how you can use alternative strategies in this environment. Steve, welcome.
Hi.
So to begin with, and before we get into the intricacies of multi-strategy, what is the purpose of multi-strategy? Why should investors pay attention to this opportunity?
Multi-strategy is an approach to investing that incorporates a whole range of different strategies which net against each other. So we look for a diversified set of return streams, combine them together, and the investor gets the outcome of that combination. In addition, it allows us to move capital rapidly when the opportunity set morphs during economic cycles.
Okay, and you use 7 strategies in the portfolio. Which has been the best performer over the past 12 months? Why is that?
Probably over the last 12 months, risk transfer has been the most profitable in our portfolio. The opportunity set there has been one of positive carry, and most positive carry strategies over the environment that was 2023 have been particularly attractive, as we've seen a pretty benign outcome and reasonably wide risk spreads. So wherever the investor's been exposed to carry, it's been usually a positive outcome.
Okay, and what has the switch from a really low interest rate environment for over a decade to a high interest rate environment meant for multi-strategy funds? Does it mean more or less opportunities for alpha generation?
So the difficult part with a switch like the interest rate move is really in the transition, the period when markets reprice and the inventory that you hold in various strategies is repricing, usually against you by definition, where prices are moving or risk spreads are moving wider. That transition is extremely difficult to run through. The opportunity comes from wider risk spreads. Once you're through that transition, and the opportunity to expose the investor to wider risk spreads and more profitable opportunities is an extremely attractive one. So the question really then becomes, when are we through the transition? Are we at the point where to fully deploy capital and make use of those opportunities? In my mind, we're probably partly way through that transition. The market is pricing a very benign outcome in terms of soft landing in the United States, possibly even a no landing. And as a consequence, there's a lot of confusion and movement, short-term vacillations in interest rate markets. So until there's a clear destination for interest rates going forward, I think it's difficult to say the transition's over, or that the next cycle of repricing to a lower interest rate environment as a consequence of slower economic activity is upon us. So I think it's one of those periods where there's a lot of treading water, a lot of cautious investing, looking for clearer signals of where we're going next.
Okay, taking a deeper look at that, should investors be concerned about the US's fiscal path at the moment, and what strategies perform better in this sort of environment?
So the US fiscal situation is unsustainable in the long term, and I think even Jerome Powell made that comment recently in some of his testaments to Congress. It's clear to all of us that $36 trillion and growing at the rate of about $3.5 trillion a year is not a sustainable path. There simply is a massive crowding out of private investing going on. It's not always obvious, but where you're consuming more than you're saving in an economy, and in the context of the US, which is such a large economy, that's true almost globally, that the US economy is consuming far more than its fair share of global savings, that at some point there's going to be a pricing reset to borrowing. Now, there's no indication that that's true in the current pricing structure of US debt. So if we look at the yield curve, for example, the US yield curve has almost no term premium built into it, which would indicate a risk premium starting to get priced into future refundings. However, the US spent last year mostly funding at the front end of the curve. That was clearly a clear decision by Janet Yellen to expect lower rates and not to lock in the funding cost of the deficit at very high levels. To the situation where the rates don't decline, and if we're in a no landing or a soft landing environment, no reason to think that interest rates should get cut dramatically from where they are, or as quickly as we, for example, was being priced at the beginning of the year, that term premia should start to come back in. And I think when term premia start to get priced back in and the yield curve disinverts, and if we start to see tails in auctions which are not clearing properly, then the repricing's upon us. But it's one of those things that doesn't matter until it matters, and we just don't know when that will be.
So I'm going to turn now to some of your strategies. Event-driven strategies focus on corporate events and capital structure. Can you share an example of an event that you've taken advantage of recently and how you traded to manage it?
In 23, the sort of core focus for M&A activity in the United States was Microsoft Activision, and it was a very political decision. Microsoft were looking to enter the gaming industry, and Lina Khan, the head of the FTC, decided that was anti-competitive. So the deal spread widened dramatically on the expectation that the deal would get blocked. And we saw a whole series of court processes. It also got blocked in the UK. Eventually, the politics revolved around court decisions that in fact gave the go-ahead to the trade, and because the US gave the go-ahead, eventually the UK folded. So we saw extreme volatility in the deal spread, depending on which was very much dependent on expectations of court activity and outcomes. That volatility by nature is a perfect opportunity for trading. Wherever there's risk and volatility, it sets up the opportunity to set up trades, and we traded multiple times during that process, closing positions and opening positions depending on where the deal spread was at the time.
Okay, and portfolio protection was a major detractor in your portfolio last year, but in February and March it's been a significant contributor. What's been the reason behind the turnaround, and what are you expecting in the coming year?
So we use a number of strategies in that section of our portfolio, and it's really designed to give positive outcomes in markets where volatility moves higher, and that usually happens or systematically happens when asset markets break or where there's unexpected outcomes in asset markets. During 22 and 23, we had an expectation that the transition from low interest rates to high interest rates would create greater negative volatility in equity markets. We still remain somewhat surprised that equity markets took it quite so easily. It's a really quite dramatic move, particularly not only in nominal interest rates, but real interest rates moving into significant positive territory. We've not seen that since 2007. We all know what happened after 2007. And so it was definitely the wrong decision for us to increase the amount of protection in our portfolio with hindsight, but we believed it was the right thing to do to mitigate downside in our portfolio. What's changed dramatically in 24 is the structure of vol markets. In 23, implied volatilities were relatively high, and realized volatilities were low and below the level of implied. So you're carrying a portfolio of delta hedged tail options in 23 was expensive. It produced a drag on our performance. In 24, realized vol is low, but implied vol has fallen to match it. So they're roughly in balance. We can gamma hedge and pay for our theta bill, which before we couldn't gamma hedge and pay for our theta bill. Our theta bill was too high.
So on a personal note, do you have a favourite strategy that you like to turn to?
We joke that, David and I joke that each strategy is like our child. You can't pick your favourite, but I only have one child, so that's probably not a fair simile. I love fixed income relative value and currency trading. That's my background for 30 years. I've had some phenomenal experiences as a consequence, so that is my personal favourite. And obviously for a decade or more, when interest rates were very low, fixed income volatility was almost non-existent, it was a strategy that was asleep. But since we've gone through the transition of interest rates, and interest rates are now, volatility in interest rate markets are at almost historical highs, the opportunity set there is great. The repricing of interest rate expectations and curve, in particular curves across the globe, are just full of great opportunities for us going forward. And I think maybe the new child, which that is in our portfolio, is my current favourite.
So finally, what's one piece of information that you've recently become privy to that you wouldn't have had access to or known about had it not been for the position you are in today? What's your view from the top?
That would be inside information. We never trade on that. I think, perhaps the piece of the world that I think I've sort of decomposed recently is what's going on in US real estate and the regional banking system. And I think one interesting supposition is that there is a lot of impairment within the 2,000 plus regional banks that are 100 billion in assets or less. It sort of came to the forefront in the Silicon Valley Bank collapse. But it's really a situation of poor interest rate hedging and really quite outsized exposure to commercial real estate in the US in these banks. Now, part of the monetary transmission mechanism that we've been used to over many decades of business cycles is that as interest rates rise, banks stop lending, their lending process slows down, and that lending process is what creates money in the economy. That's the creation of new loans, new balance sheet in banks that creates money supply. So when interest rates go up and that process goes into reverse, that's what creates the contraction that the central bank is looking for. What's changed in the economy is private credit. Private credit has become a boom industry. And what it's done is it sits and has replaced the lending capacity of regional banks. And I think one of the reasons why we've not seen the US go into a reverse or a slowdown as fast as we would expect, given the interest rate moves that we've seen, is that private credit has disintermediated the regional banking system. And it's very hard for the Fed to control something that sits outside the banking industry. This secondary lending is happening outside its purview and outside its levers of control. And I think that's a new piece of data, a new piece of the system that is making us all have to sit and think about what does that mean in terms of monetary transmission? Is there a recession coming? Is bank lending as important as it used to be?
It's a new world.
Correct.
Thank you so much for sharing your insights with us today, Steve.
Thank you.
If you've enjoyed this interview, please subscribe to Livewire Markets on YouTube. Thank you for watching.